Venezuela announced that they were going to be lopping off another bunch of zeros from their currency. But they are definitely encouraging and here's the name of the new digital currency, the digital bolivar. Shocker. This is what they do. They always keep the name the same so people think it's the same thing, and then they just change everything around it. What they need is confidence in the currency. What they don't have is confidence in the currency, and this is not going to help it. Now, I did take a look at the Venezuelan stock market, and it's been basically anchored at zero since March, and not updated, at least on Trading Economics. I'll look in a little bit more. But will lopping off the zeros help? Of course not. They just change the formulas. They don't change behavior. And that's true with derivatives, which I did glance through these questions. It's true with derivatives. It's true with everything that they do, because the job is wealth transfer from the many, from the public to the few. Here's the thing about debt. There's two types of debt. There is self-liquidating debt. So if you as a business take out these funds and you then convert it into expanding your business so that you can generate more income, that pays off that debt, as long as it's fixed rate. So if you're going to take on more fixed rate or more debt, there are two things you need to make sure of. Number one, that it is indeed fixed rate and not variable rate debt, because variable rate is what will kill you. And number two, that you have the means and the ability, if you needed to pay it off, bam, like that. And that's where, really the gold comes in to give you that ability. So, they're basically giving you money for free. I'm not telling you to go out and take on a lot of debt, because everybody's got to do what they're comfortable doing. But you do need to have your ability to pay that debt off. So there's a balance there. If so, what happens to these debts when there is a reset? Well, the goals that I have read through all the papers that I read at the IMF, the BIS, wherever I read this, is that the goal is to have all assets broken down and held in digital form, making it very, very easy for you to spend. So, what happens to this debt in a reset? Well, if you have the ability, then boom, you pay it off with dollars that have virtually no value, and certainly a whole lot less value than they have right now. So what might have taken 10 ounces of gold might only take a quarter of an ounce of gold during a reset scenario, okay? But if you cannot, then you're going to probably, most likely, they will reset this debt, and it will be much more challenging for you to ever pay it off, putting you in a position where you're going to agree to any of their onerous plans that they have for you. So you want to be careful with debt. I don't think taking on debt is a bad thing, as long as you can make sure it's fixed and you can pay it off like that. And I can't see the real government continuing with, for example, the unregulated derivatives bets. I can see those bets getting bigger, because prior to 2008, and unfortunately I didn't know about the print screen then, but central banks, they had a minuscule amount of derivatives, and they were typically against foreign exchange, and it was to hedge their bets. Once 2008 came, well, what did they do? Well, first of all, they bought a whole bunch of the garbage derivative bets that can never settle from the banks, took it off the bank balance sheet. And what everybody really needs to understand is that you and I, taxpayers, are responsible for the Fed's balance sheet, as well as the government's balance sheet. And so it's really easy to spend someone else's money. So I am 100% certain that this will get worse and worse and worse, because that's what I've witnessed as this whole piece has evolved. Is this really a move to help people buy gold and silver? No. They don't want you to have that protection and that insurance. They don't want that because this is about wealth transfer. Remember, wealth never disappears. It merely shifts location. And what we've witnessed really since 1913, but particularly since 1971, is that income and wealth inequality has grown enormously. And since 2020, exponentially. So what? You think that they're going to do this? You know, whenever you were born, inflation was baked into the very foundation of fiat money. So do you really think that they've been doing this, robbing you your entire life? But right at the end, they're going to go, oh, wait, we want to make sure that the individual is protected. No, you have to, well, in my opinion, you do whatever you're comfortable with. But in my opinion, you have to become your own central bank. That's why you have to have gold and silver like the central banks do. That's why you got to do it, because that is your insurance. It enables your independence, and it enables your ability to have that wealth shift your way. Well, EBITDA is earnings before interest, taxes, depreciation, and amortization. So it is an indication of how much earnings are coming into the company before they do all of that stuff. Well, that's pretty important if you're going to pay your debts that you've been accumulating. Junk bonds means that these are companies that are struggling at best to make their payments. And the lower you get down on that junk bond track to stay in business. So the low interest rates that the central banks have engineered have helped these companies kind of stay in business. But for holders of those bonds, whether they be in ETFs or mutual funds or pensions or annuities, any of these places that we're buying for retirement, and graded bonds are investment quality bonds. Well, if the company is in good standing, I mean, you think about it. If you have a higher credit rating, when you go to buy and borrow money, you're going to get a lower interest rate. If you have a lower credit rating, you're going to get charged a higher interest rate. But where you and I might be, I mean, I don't even know what it is these days, but if you're going to buy a car, you know, it used to be like 25, 28% if you had bad credit, something like that. Because again, in this low interest rate environment, risks have been completely mispriced.